Welcome investors. If you're watching this video, you're after long-term passive investments that grow over time and provide good solid returns. And whether you're starting with thousands of dollars or millions of dollars at a time, what we're going to look at works for all types of investors in this passive sense. And the key features are that these are very low cost, so low fees, even less maintenance. The companies have returns in what we'd expect from the market, which is far superior than what banks are providing at the moment through term deposits and the like. And it's also much easier to do this, or to set up these investments, than it was 5-10 years ago, and even more, a couple of years ago. There's been some huge gains and changes in the industry. So we'll have a look at why. But to have a look at all the things that we'll run through, we'll see what the investments are. We'll have a look at who's running them. We'll look at what's in them, as in the underlying investments, and how much maintenance is required and why it is so low, which one to buy, how to buy them, a savings plan so we can progressively add to these investments over time, and then what we use them for. So to start off with, what are they? We're looking at the big names of town. So we're looking at iShares, Vanguard, BetaShares. These are some of the biggest ETF providers in the country, and some of these names are also the largest globally. Now, what we've seen is that there's been some recent competitive offerings, and I'll move this over here on the screen so you can see what we're talking about. So make it all small. This is BlackRock, who provide iShares, and what we're looking at is their portfolio offering. So they're suggesting that you go through their suite and you pick a basket of ETFs to create your core portfolio. So some of this one, some of that one. Have a look here. They're suggesting that you're looking at the ASX 200, a core ETF. You're looking at corporate bonds, MSCI All World, and then bundling them together. So cash, shares, bonds, and whatever else that they can come to offer with different corporate bonds and the like. This is what many people did 3, 4, 5 years ago, and we're trying to get happening 10 years ago, but what we had on offer wasn't as much. Now we move over to a more advanced product, and we have a look at Vanguard's offering here. So zoom out so you can see. There you go, this is Vanguard. This is their balanced index fund, and this was the first offering to come to market in Australia like this, and it was definitely well received. So if we scroll through and see what they're trying to do, 2.9% management fee, which is better than all these 0.12s, 0.07s that iShares and BlackRock were doing, because you also have to then manage those investments together. What they were doing here with Vanguard is saying, we'll manage the reweightings for you, we'll manage all the bits and pieces, the large, the smaller, how we have this asset mix coming together. And they'll do that through, let's scroll down here, to see here are the underlying investments. So the allocation to the underlying Vanguard index funds. You've got an aggregate bond fund, so there's your bond, your fixed income, Australian shares, little surprise what's going on there, a whole basket of Australian shares. Fixed interest, again, fixed interest, international shares, so you're looking at your US, your European, China, Asia, Japan. International shares, again, looking at the hedge side of things. And then small companies index and emerging markets, so the smaller parts of Asia. Now, that comprises 100%, and as you'll note here on the left, every single one of these funds is a Vanguard product. So it's a bit like going to a bank and saying, can you provide me with a mortgage? Which one's best for me? They're naturally going to go to their own suite of products. So they'll choose from what they have on offer what's best for you, which is what Vanguard have done here. And how that's changed is what we have from BetaShares. So if we go back, move this out of the way so you can see, here's BetaShares. Now we'll go to their homepage and navigate our way through so you understand what we're looking at here. Starting off with their funds, we're going for diversified, which is similar to the Vanguard. And let's go to the All Growth, our funds. Let's see if the website can keep up. Our funds, diversified. Here we are, diversified All Growth. So we'll have a look at this product, which is the next iteration of what we saw from Vanguard. So the product, the All Growth ETF, is doing very much the same thing. They're picking a whole basket of different assets, bonds, shares, even property, and putting this combination together for you and managing it. So we jump down here. They're the products on offer. And this does work because they do have that bundled set. And that's why it can be, some people call it set and forget. Most of us call it bottom drawer. You still want to have a look at it and reference it, but they can be very passive in that nature because they're consistently managed. So that's how they become extremely passive, and more passive than what we saw with the iShares BlackRock models. But moving through, we do see that mixture that they have, which is that asset allocation. And here we can see asset allocation, financials, IT, consumer discretionary, all the GICS industries that we see in the share market, and they get that exposure through different countries as well. So that's who's running them, that's what they are, and that's what's in them. But to look at the next level down of what's in them, we'll have a look at what BetaShares have here. We've got the country index. We also have the asset allocation. But we want to see what the underlying investments are. And that's where we come through. If you want to see their fact sheet, here's their fact sheet. So it runs through roughly what it does. So you can see again the management fee is 0.19. We compare that to Vanguard all the way back up the top here, 0.29. Now Vanguard have only their own products. BetaShares are going to market and saying we're going to put all of these together for you, and we'll choose the best of breed, the best that we can get on the market. So we move through to see that's the fact sheet, but what we want to see is also what's within the portfolio, and this is what we've downloaded here. We'll have a look in the announcements here. So portfolio holdings, and we've picked that up here, which is this Excel sheet that we've downloaded. It's got yesterday's date on it, and you can see in here that we have the Vanguard total stock, which is a competitor's product. They also have Spider's portfolio development. So they have their own product, BetaShares Australian 200, which is like the ASX 200. They've got Vanguard and Spiders in there, so they're choosing best of breed. Their investment committee goes away and they rebalance portfolios once a quarter, and they choose what to put in there. And this time they've chosen the Vanguard Total Stock ETF. So let's go and have a look and see if we can find out what these companies look like and what the holdings are. So let's bring it over here. Let's come back to the spreadsheet so you can see what we're looking for, and let's just go to Google and try and find what the underlying holdings are of this Vanguard. Now what we are going to see is that it is the largest set of companies in the world. We're looking at the US, so I'll move this back over on the screen. There we go. So as that loads, the total stock market index, here's ETF. What we want to do is scroll down and see what the holdings are. Do you see that asset mix once again that replicates a lot of what's going on here within BetaShares ETF? So there's your asset mix, financials, IT, and so on. And we see from Vanguard, we've got a large weighting in consumer discretionary, but an even heavier weighting in technology. And if we look over here at the top 10 largest holdings for the month end, it's Apple, Microsoft, Amazon, Alphabet, Facebook, Tesla, Johnson & Johnson, Berkshire Hathaway, JP Morgan Chase, and Visa. Most of them are household names, and that's what's in the portfolios. So that's what BetaShares have put in here. Now we move over to the maintenance side of things. There's not much to maintain, because when we're looking at these portfolios, as you can see, this asset mix is the critical part. As the economy changes and evolves, we want to be changing our allocations. If the United States is not going very well, but the UK is, well, it's been kind of the opposite in the last few years with Brexit, but we want to be changing those levers. And that's what that's what is happening when they reweight. So the BetaShares one is reweighted every quarter. And that's not just a static amount, but based on what's happening around the world. So that's active management. And the reason why we want active management in an environment like this is because a perfect example of what's happened in 2020. Here we are in 2021 looking back and seeing all the stimulus that happened. We saw a huge amount of capital and stimulus being deployed globally. And the Reserve Bank of Australia was one of the central banks, among many others, that said we're going to fix the interest rates for the next few years. What we're going to do is we're going to lock in these rates so that we can provide stimulus and certainty for those who are looking to borrow and invest their capital. And that's what's helped keep the interest rates extremely low. So as those interest rates have been lower, it's created an artificial peg within the interest rate market, or what's the bond markets. And as those bond markets are fixed, it means that the old world ETFs, such as, let's go back to have a look at Vanguard, we'll move that over here. So Vanguard's products, within here, they've chosen these index funds. These index funds were made years ago, and they have mandates, and they're going to have short term, so bonds expiring now, think of a term deposit expiring now, maybe 12 months, 3 years, 10 years, and 30 years. That's all throughout the duration, or the yield curve. But with the artificial movement of the stimulus packages, what has happened is that those index funds are still buying throughout the yield curve, whereas an active manager looks at it and says, well, we're responding to what the RBA has said. They said they're going to keep interest rates here, so they're a sitting duck, that old index fund, and we can trade around that index fund and make profit while they're stuck to their mandate. And that's exactly why we want active management in times that is consistently changing, which the economy and global markets always are. So that's the key reason why we'd want an active management through selection and best of breed like a BetaShares rather than a Vanguard, or the old form, which is the iShares. And you're going to have to make those changes yourself using this suite they recommend. But with BetaShares, it's more passive, far more passive. Now we look over to which one to buy. Now when we look at these generally, it's personal circumstances that'll be different. You'll have different ones to your neighbour, the person across the road, or the person you sit next to at work. And everyone's circumstances are different. But generally, younger people tend to be invested at the higher end of the risk curve, whereas older people tend to be more at the lower end. Although what we can find is that we'll often complement these portfolios, so these higher growth portfolios, for some of the higher end of the age spectrum, with a more passive investment that's maybe paying 7 or 8%. It might be a term investment that's only 12 months. But if they're getting such a fixed term amount, that's a lower risk investment. It's lower risk than shares. So we'll often complement that kind of static investment with a higher growth one of these BetaShares. And together we manage those two levels depending on what the opportunities are outside of the markets. You can click on the links in the description to learn more about those kind of investments and discuss in more detail. But then we move over to how to buy. This one's pretty simple. It's just like you would on the ASX. You'd buy your BHP shares or your ANZ. These products are exactly the same. They're listed, they're exchange traded funds. They're on the ASX. Now we have a look at a savings plan, because this is a common question that we get. People say they want to consistently invest. They want their savings to be working for them as soon as possible. It might be $100 every time you get paid. It could be $1,000 a month. Whatever it is, they want to consistently be adding to that growth, that wealth accumulation that's happening in a passive manner. So these diversified funds are perfect for adding to. It's just like superannuation, except you're buying just like you would BHP or ANZ shares. That can become really expensive over time and creates a nightmare from a taxation perspective, because in the years to come you've had so many progressive buys that you then need to calculate capital gains tax, and then you look at when the dividends came in. It can be a nightmare. So there are better ways, and you can click in the description to discuss how to set up an efficient savings plan that doesn't create a tax nightmare. But then we can also move out to look at what we use these for. So as we mentioned, it's a progressive savings plan. Maybe your long-term goal might be to save up for a home deposit, or just building a passive wealth engine. Other ones are debt recyclers, so those who are turning their home mortgage into a tax-deductible expense while growing a share portfolio on the side. Again, click in the link in the description so you can learn more about tax-wise passive investment strategies or passive investment income streams. And then finally, low-touch portfolios. So these are low maintenance and low stress. Some clients just want to have a bulk of funds invested, passive income stream that's growing on the side and doesn't require a lot of maintenance at tax time or management throughout the year. Now we look at the next steps. So when you're coming through, it's definitely important to do your own research. This is not a personal recommendation. This is not say this is the best product for you. These are saying, from our opinion, generally, these are the best offerings on the market at the moment. It can and will change over time. So this is not advice personally for you. However, these are on the ASX and you can make your own call, just like buying BHP, so it's really simple to do. If you'd like to know more about low maintenance, bottom drawer investments like these, setting up a savings plan, or more tax effective ways to grow your passive wealth and income, then just click on the links in the description to find out more.